Welcome back to the deep dive. Now, you know we cover Bitcoin market intelligence every single day, but today's briefing is different. It confirms a really significant, abrupt reset in sentiment. We are looking at a market capitulation that has officially pushed prices down to a 6-month low. So our mission today is to get past just the price chart. We really need to understand the precise cause. How did we fall from over $100,000 down into the $93,000 range? And maybe more importantly, we need to analyze this critical divergence that's opening up between the short-term macro-driven chaos and the long-term structural health of the asset.
Right. And if we just jump straight to the conclusion, the central idea from our sources is this. We were seeing is a liquidity crisis.
Okay, not a thesis crisis.
Exactly. This isn't about Bitcoin's long-term value. This price collapse is a direct, almost reflexive result of institutions de-risking. And it's all being catalyzed by a very specific and kind of unique piece of macroeconomic uncertainty.
Okay, so let's start with the immediate damage, the technicals. The market just completely failed to hold that critical $94,000 support level. And that failure established new 6-month lows. The bottom wick, I think, scraped just near 93,000.
A really sharp drop.
It is. And that technical failure means the drawdown from that October peak is now over 24%.
Which is a staggering number when you think about it in terms of market cap.
It's wiped out something like $600 billion in market capitalization. But I think the real psychological blow here is that for the first time this year, in 2025, Bitcoin's year-to-date performance is now negative. It's sitting at about minus 1.2%.
Wow. That changes the whole story for the year, doesn't it?
It completely changes the narrative. In fact, the title of 2025's top-performing asset has now been pretty convincingly claimed by gold.
Which is still holding on to, what, 36% gain?
Over 36%, yeah.
And that year-to-date flip, that's a huge trigger for headline risk. The sentiment just reflects that completely. We've seen the fear and greed index just plummet.
Where is it now?
It hit a low of 10. That's deep in extreme fear territory. We actually haven't seen that level of widespread panic since the market bottomed out during the COVID crash in March 2020.
So what caused this? What was the trigger for this sudden run from risk?
All the sources point to one direct driver: the market suddenly and violently repricing Federal Reserve rate cut expectations.
Right. I remember earlier this month, the odds of a December rate cut were almost a sure thing.
They were near 90%. That narrative is completely dead. As of today, those odds have collapsed down toward 40%.
So the critical question is why? Why did the market reprice the Fed so aggressively?
It all goes back to a really unusual political event, sort of a black swan. It's the aftermath of that long government shutdown.
Oh?
The White House confirmed that the October unemployment rate, which is, a key metric the Fed uses to see if the economy is weakening, is officially canceled. It's unrecoverable.
So the data just doesn't exist.
It just doesn't exist. And this is a perfect example of how a data vacuum can create panic. The Fed is strictly data dependent, right?
Right. They need a reason.
They need a reason. To justify a dovish rate cut, they needed to see data, like rising unemployment showing the economy was slowing down. Without that October data point, they have no justification to ease policy.
So their hands are tied.
Completely.
Yeah.
It forces the market to price in a hawkish hold until new data comes in. And that expectation is the direct causal link to this institutional flight and the risk-off selling we're seeing.
And on the ground, that selling had immediate consequences. The moment we reached $94,000, it just instantly triggered a huge deleveraging event in the derivatives market.
A classic cascade.
Total crypto-wide liquidations topped $500 million. Some reports are even pushing that number closer to $617 million in forced sales.
And it's a third major liquidation event in just the last week. So it's really resetting the leverage in the system.
The market is definitely cleaner now, but the whole technical map has shifted downward.
It has. So if you're watching the charts, there are a few key levels now that define this threat zone. The immediate floor is that recent low, somewhere between 92,970 and 93,050.
And if that doesn't hold?
Then the next major support, what traders call S2, is down in the $91,900 to $92,000 region. That's sort of the main line in the sand for traders right now.
And the worst case scenario, the capitulation target.
If that line truly breaks, the technical target, S3, is sitting down around 89,200 to 90,000.
But, those are just lines on a chart. They're based on past trading, Our sources are pointing to a fundamental line that might be way more important than any of those technical levels.
Because it's based on real massive amounts of capital.
Exactly. I'm talking about the Bitcoin ETF realized price, and that number is $86,680.
And this number is just fundamentally more important than technical support because it is an on-chain, cost-basis driven floor. It's tied to the newest and most influential investors in the market.
Explain what it represents.
It represents the aggregate cost basis. So essentially, the collective break-even point for all the capital that has been invested in the U.S. spot Bitcoin ETFs since they launched this year.
So this is basically Wall Street's psychological barrier.
That's the perfect way to put it. If the price goes below 86,680, then on average, every single 2025 ETF holder will be underwater. They'll be holding at a loss.
And that could trigger?
That risks triggering a new and potentially much larger wave of institutional capitulation. You'd have risk managers and committees being forced to cut their losses. That's where the real panic could start, completely separate from the derivatives traders.
But if we shift focus from the price to the sort of underlying health of the network, what's fascinating is that the on-chain data tells a very different story.
It really does. On-chain analysis confirms that this decline is being overwhelmingly dominated by short-term holder capitulations.
So newer entrants and high-speed traders.
Precisely. The spent output profit ratio, or SOPR, which tells us if coins are being sold at a profit or a loss, is consistently below 1 for these STHs.
Which confirms quantitatively that the newer money is panic selling at a loss.
Correct. And what's important is what we're not seeing.
We are not seeing long-term holder panic.
Not at all. So what we're actually witnessing is a classic cyclical transfer of assets. It's a flush out from what we call weak hands.
The people who bought the local top.
Exactly. Directly into the strong hands of strategic whales and custodians who see this crash as a buying opportunity.
And we have hard evidence of this happening.
We do. Hyperscale Data, for instance, they put out an update confirming they were actively buying the dip between November 10th and the 14th.
How much did they buy?
They acquired $6 million worth of BTC, and their final purchase during that window had an average price of $94,368. They were buying right into the teeth of that volatility.
And then today, Strategy announced they acquired another 8,178 Bitcoin.
Right. Just underscoring their strategy of continuous accumulation no matter what the market is doing.
You see a similar divergence in the stock market too, right?
Absolutely. The high beta crypto-linked stocks like, Coinbase, Marathon, Riot, they're all plummeting as you'd expect. They're just direct plays on the falling Bitcoin price.
But at the same time.
At the very same time, the underlying efficient miners like HIV Digital are reporting incredibly strong fundamentals. Their Q2 revenue was up 285% year over year.
It just shows that the actual business of mining and building out the infrastructure is, structurally decoupled from this short-term macro panic. And speaking of infrastructure, if we look away from the U.S. for a moment, we have to talk about what's being built overseas. There's a major, and I mean major, structural development happening. The Singapore Exchange, SGX, is launching institutional-grade Bitcoin and Ethereum perpetual futures on November 24th.
And you really can't overstate the significance of this. The perpetual futures market is the biggest derivatives market in crypto. It's over $187 billion in daily volume.
But it's always been kind of the Wild West, unregulated, opaque.
And now SGX, which is a major regulated traditional finance exchange, is creating a proper exchange-cleared venue for this exact product.
So it's bringing it into the fold of traditional finance.
It is. This move essentially de-risks the largest part of the crypto derivatives market for institutional use. It's a massive structural bridge being built right as U.S. markets are panicking over a jobs report.
Okay, but now we have to pivot to the unresolved crypto-native risk, the thing that exists totally separate from the macro sell-off, and that's the contagion from the Elixir and Stream Finance collapse.
Right. Now, Elixir seems to be handling its side of things. They announced a one-to-one USDC redemption for their stablecoin holders, so that specific risk looks like it might be contained.
But Stream Finance is the bigger problem.
Stream Finance is the systemic risk. Today's research confirms they have $285 million in total debt. And the critical issue here is that its synthetic assets are being rehypothecated.
Okay, let's pause there. For everyone listening, what exactly is rehypothecation in simple terms?
I mean, think of it like using the same collateral for multiple loans over and over again, recursively. You collateralize a loan with asset A, then the lender turns around and uses your asset to collateralize their loan, and so on.
It's credit house of cards.
It's a perfect credit house of cards. The failure of one small link, like stream finance, threatens this widespread systemic contagion loop because that collateral is double or even triple counted across major DeFi protocols like Euler, Silo, and Morpho. That fragility is still there, and it's an active source of market risk.
So, to summarize the core conflict right now, on one hand, you have this rapid transfer of assets driven by a U.S. data vacuum and institutional flight. And on the other hand, you have this stark contrast of continued strategic buying from corporations and this quiet development of major regulated global infrastructure.
It all boils down to an internal structural fight, really. It's short-term macro panic versus the long-term structural foundation. And that raises the big question right now.
Which is?
In this high-leverage environment, which line in the sand holds more psychological weight? Is it the traditional technical support levels down in the low 90s? Or is it that fundamental $86,680 cost basis of the newest, more significant institutional players?
The ETF holders.
The ETF holders. That psychological battle is where the true market bottom is going to be defined.
So for you, our listener, here's what to watch. The delayed September jobs report, it's now scheduled for release on November 20th. Because the October data was canceled, this delayed September release is now the next major piece of data that could finally give the Federal Reserve, and by extension, this panic-stricken market, the tiny bit of clarity it so desperately lacks.